does a 120-year-old company that, historically made its money digging holes in the dirt and selling heavy mechanical brass water meters manage to trick Wall Street?
Right, like completely fool them.
Yeah, trick them into valuing it like some Silicon Valley software startup. I mean,
Yeah, yeah.
when you picture a company commanding a massive valuation multiple, you usually imagine like cloud infrastructure.
Oh, totally. Artificial intelligence, server farms, that kind of thing.
Exactly. You certainly don't imagine municipal public works. But today, for this deep dive, we are looking at an incredible paradox.
It's really quite the story.
It really is. We are unpacking how a legacy industrial manufacturer executed this digital transformation so convincing that the market treated them like a pure play sauce darling.
Yeah, a software as a service tech giant.
Right. And we're going to look at what happens when that digital illusion, violently collides with the friction of the physical world.
Because it is a phenomenal case study. It shows how a market narrative can just become entirely decoupled from the actual physical constraints of a business model.
Completely detached.
Yeah, it's a masterclass in margin expansion, sure, but simultaneously it's a really brutal reminder of, well, valuation gravity. What goes up must come down.
Absolutely. So we're going to unpack this through the lens of a massive, exhaustive 2026 financial and strategic research report on Badger Meter, Inc., or BMI for short.
Right, BMI.
We're dissecting their recent Q2 earnings, their structural business pivot, and what it tells us about this collision of physical infrastructure and software.
There is a lot to get into here.
There really is. But before we dive into the mechanics of this illusion, just a quick note for you listening. To access more advanced researches, applications, and our latest personal Deep Value agents, welcome to explore and join the Deep Values APP.
Highly recommend checking that out.
For sure. And to track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store or Bubble Watch from Google Play.
Got to keep an eye on those bubbles.
You know it. Also, just a quick disclaimer, all analysis is based on publicly available sources and may be subject to revisions or differing interpretations.
Right.
All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. So, basically conduct your own due diligence before making investment or financial decisions.
Always do your own homework.
Exactly. All right, so setting the stage here, to really understand how Wall Street fell head over heels in love with this company, we have to establish their baseline, right?
Yeah, we have to look at where they came from. Because Badger Meter isn't just shipping crates of simple mechanical dials with, spinning physical gears anymore.
Right, the old school stuff you'd find in your basement.
Exactly. Over the last decade or so, they've executed a highly strategic pivot.
Mm.
They moved away from heavy mechanical brass meters and built what they call their Blue Edge suite.
Blue Edge.
Yeah, it's an integrated technological ecosystem. It starts with these advanced E-series ultrasonic water meters,
Ultra.
right? Which use high-frequency sound waves to measure flow rather than physical moving parts.
Yeah.
And those meters are connected to Orion cellular data transmission endpoints.
Okay, let's unpack this. Because this specific technological shift, this is exactly what created the massive market illusion we mentioned at the top.
Right, this is where the magic trick happens.
It really is. The analogy that comes to mind, it's like buying a traditional heavy metal tractor manufacturer, right? But suddenly you're valuing it like an AI data firm simply because the new tractors have like an integrated GPS screen in the cab.
Yeah, that's a great way to put it.
But the underlying business is still heavy machinery. So how exactly did BMI manage to pull off this massive re-rating on Wall Street? How did they convince analysts to just ignore the physical hardware?
Well, what's fascinating here is the underlying mechanics of their margin expansion. I mean, the market wasn't entirely delusional, right? They were responding to a genuine structural improvement in the unit economics of the business.
Okay, so there was real improvement.
Definitely. When a manufacturer transitions from smelting and machining raw brass to assembling advanced engineered polymers, ultrasonic sensors, cellular radios, the cost profile fundamentally changes.
Right, you're not paying for heavy raw metal anymore.
Exactly. But the real leverage, the massive multiplier, came from the software tier. Every single time BMI sold one of those cellular endpoints to a municipality, it was tethered to a recurring Beacon software subscription.
Ah, there it is. The ultimate holy grail for investors. Predictable, compounding, recurring revenue.
Yep, the sauce model.
And the beauty of software, is that once the platform is actually built, the marginal cost to distribute it to one more utility company is essentially zero.
That near zero marginal cost is the key driver here. As those Beacon software subscriptions scaled geometrically across thousands of municipalities, BMI's overall gross margins structurally shifted upward.
How high did they go?
They hit a highly robust 41.7% by 2025.
Wow. Over 40% for a hardware company.
Yeah. Net sales reached a massive apex of $896.7 million in 2025, and their operating earnings were humming at an incredible 19.24% of sales.
That is insane for an industrial firm. So Wall Street looked at that margin profile, looked at the growing percentage of recurring SaaS revenue, and just, seemingly suffered collective amnesia.
Pretty much. They totally forgot about the fact that Badger is still an industrial hardware company at its core.
Yeah.
I mean, the market assigned them a pure-play software multiple, pushing their P/E ratio to an astronomical 50x.
50 times earnings. They priced them as if they were selling enterprise cloud storage or something.
Right, completely ignoring the physical friction of their industry.
Yeah, because to get a municipality onto that high-margin Beacon software subscription, a utility crew still has to physically drive a heavy-duty truck out to a neighborhood.
Yeah, they had to roll trucks.
They have to tear up the pavement, dig a physical hole, and bolt a piece of hardware into a municipal water pipe. You cannot download a water meter over the internet.
You really can't. The software revenue is a strict derivative of physical hardware installation. And the industry is currently undergoing this massive secular shift.
Right, from the old way to the new way.
Exactly. Moving from legacy manual meter reading, where a municipal employee literally walks from house to house, writing down numbers on a clipboard, to cellular AMI.
Advanced metering infrastructure.
Right. And these are massive turnkey infrastructure projects for municipalities that require fleets of workers, complex physical logistics, and significant upfront capital to replace an entire city's grid all at once.
Which brings us crashing into the physical reality check of Q2 2026.
Yeah.
Because that software illusion was violently
It
shattered.
was a brutal wake-up call.
We go from the absolute peak of 2025, record sales, massive margin expansion, complete euphoria, directly into this brutal reality. But I have to be devil's advocate here.
Okay, go for it.
If this software ecosystem is so deeply integrated and the switching costs for a city are prohibitively high, which the report makes very clear they are, why did this stock plunge up to 24% in a single day back in April 2026?
Yeah, a quarter of its value, just gone.
Right. And then it just continued bleeding into these highly scrutinized Q2 results. So what happened?
Well, if we connect this to the bigger picture, the answer lies in the mechanics of local government funding and macroeconomic headwinds.
Okay, the macro environment.
Yeah. Cities simply do not buy infrastructure on a smooth, predictable quarter-by-quarter curve. To fund a massive, multi-million-dollar turnkey AMI project, say, replacing 50,000 meters across a mid-sized city, a local water utility usually has to issue municipal bonds to raise the capital.
And we all know what happens when interest rates stay elevated for a prolonged period.
Exactly. The math changes.
The cost of capital for issuing those municipal bonds becomes incredibly expensive for local governments. A project that made total financial sense at a 3% interest rate suddenly breaks the local budget at 6 or 7%.
Bingo. That cost of capital pressure essentially forced municipalities across North America to either delay these massive turnkey deployments or just significantly scale them down.
They just couldn't afford it.
Right. The mechanism is really straightforward. When those big physical hardware projects stall out because the city can't afford the bond issuance, the corresponding software subscriptions never materialize.
The high-margin growth engine simply starves.
Yep. And furthermore, this dynamic collided with a massive hangover from the pandemic supply chain panic.
Oh, the bullwhip effect.
Yes, the classic bullwhip.
During 2021 and 2022, every utility director in the country was terrified of running out of parts. They couldn't get chips, they couldn't get sensors.
Everyone was panic buying.
So they hoarded inventory. They ordered double or triple what they actually needed just to guarantee they had stock on hand.
And that hoarding created a completely artificial demand spike. So by early 2026, you have these two forces colliding.
A perfect storm.
Really, high interest rates, making new, large-scale projects too expensive to finance on one hand. And on the other, utilities deciding to draw down their massive stockpiles in warehouses rather than placing new short-cycle orders for regular maintenance.
Right. Why buy more when you have a warehouse full of them?
Exactly. This inventory normalization freeze led directly to the Q2 2026 contraction.
Let's talk about those Q2 numbers because they are stark.
They are. Core revenue contracted 7% year over year down to $222.3 million, and earnings per share dropped 13% down to $1.02.
Wow. So the core insight for you listening is this inescapable reality. Software subscriptions simply cannot grow if the physical hardware isn't being installed in the dirt. The two are inextricably linked.
You can't have one without the other.
No, and this situation beautifully illustrates a macro version of single counterparty risk. On paper, BMI looks incredibly diversified, right? They have thousands of individual municipal clients across the continent.
Sure, thousands of separate buyers.
But in reality, those thousands of clients are all subject to the exact same North American municipal bond funding environment.
Right.
If the macro funding environment freezes, the entire board freezes simultaneously.
It's all connected. And that systemic freeze exposed the extreme fragility of assigning a 50x PDE multiple to an industrial company.
It's just too high.
Valuation models at those levels price in absolute perfection. They assume uninterrupted exponential growth forever. So when growth decelerates even slightly, or in this case actually contracts by 7%, those extreme valuation multiples collapse violently.
They just crater.
The market violently reprices the asset to reflect the new, slower growth trajectory, which is what triggered that massive 24% single-day wipeout.
So what does this all mean for the fundamental value of the business? We have a stock that suffered a massive repricing because of municipal budget cycles and inventory normalization, right?
Right.
Both of which are arguably temporary cyclical issues.
Right.
So is this a structurally broken company, or is this an incredibly resilient business just going through a rough patch?
That's the million-dollar question.
If we apply the lens of legendary deep value investors, like Benjamin Graham or Peter Lynch, how does BMI look after taking this massive hit?
Well, the report runs Badger Meter through a highly rigorous deep value framework, and the conclusion is a really fascinating paradox.
Oh, okay. Lay on me.
It categorizes BMI as a wonderful company at an unfair price.
A wonderful company. Unfair price. Okay.
It passes the operational, balance sheet, and cash generation tests flawlessly, but it fails the valuation discipline metrics miserably.
Let's break down the wonderful company side of that equation first, because looking at the financial foundation here, it operates more like an industrial engine running with zero friction.
Oh, the balance sheet is an absolute fortress. First off, they carry literally zero long-term debt.
Wait, literally zero?
Zero. In a capital-intensive manufacturing industry, operating with zero debt is incredibly rare, and it provides massive operational flexibility.
That's wild.
And second, their free cash flow margin is an outstanding 13.23%.
And we should contextualize why that 13.23% number is so crazy. Deep value investors typically look for, a conservative 5% free cash flow margin as a baseline of a healthy business.
Yeah, 5% is solid.
Hitting over 13% for a company that has to maintain factories, manage physical supply chains, and build physical inventory. It's staggering. It highlights the sheer cash conversion efficiency of adding that sauce tier to their physical products.
It really does. Plus, their short-term liquidity is bulletproof. They boast a current ratio of 3.23, meaning their short-term assets cover their short-term liabilities more than 3 times over.
So they can easily weather a multi-year macroeconomic freeze without breaking a sweat.
Oh, absolutely. They are structurally designed to generate surplus cash. They've maintained 33 consecutive years of dividend increases, placing them in elite territory for capital return consistency.
That is some serious resilience.
That financial resilience is why massive institutional value investors treat this stock as a foundational buy-and-hold asset. But as you alluded to, there is a massive but in this equation.
The but is the price tag. Even after that severe 24% stock plunge, the trailing 12 months PE ratio is still sitting at an exceedingly high 36.17x.
Still way up there.
Yeah. Benjamin Graham's strict standard demands a PE of under 15x to even be considered a value play. Over the entire last decade, BMI's PE never once dropped below 32x.
Never once.
The market persistently assigns it this massive quality premium, refusing to let it drop into deep value territory.
And that persistent premium means there is absolutely zero margin of safety for a new investor. The report actually ran a discounted cash flow model, a DCF, to mathematically determine the fundamental intrinsic value of the equity based on the cash it will generate in the future.
And the mechanics of a DCF model are ruthless, right? They heavily penalize any deviation from growth.
Very ruthless.
Let's walk through those DCF mechanics because the results are pretty sobering.
Yeah, they are. So even under a highly optimistic nominal scenario on the DCF model, where you assume BMI can sustain a 12% free cash flow growth rate every single year for the next decade.
Which completely ignores the reality of the municipal budget cycles we just discussed.
Completely ignores it. But even in that perfect scenario, the intrinsic value only calculates out to $130.94 per share.
And the stock is currently trading around $144.45. So even in an optimistic scenario that assumes zero cyclical interruptions for 10 years, the stock is still fundamentally overvalued.
Precisely. To achieve the standard 30% margin of safety that a strict value investor requires to protect against unknown risks, the stock would have to drop to a buy target of around $91.66.
That's a long way down.
It is. The current market price is demanding perpetual, uninterrupted double-digit compounding. It leaves absolutely zero margin for error in an inherently imperfect physical world.
Here's where it gets really interesting, though. We just established mathematically that the stock is historically expensive and fundamentally overvalued,
Right.
which sets up a massive contradiction in how the company's executive leadership is currently behaving.
This is the crazy part.
For an entire decade, this management team largely ignored share repurchases. To give you some context, in 2022, they bought back a mathematically negligible $427,000 worth of stock.
Basically nothing.
Nothing. Their historical playbook was to hoard cash on the balance sheet or deploy it to buy niche technology companies. But suddenly, in the first half of 2026, they completely flipped the script. They deploy their zero debt balance sheet as a synthetic shock absorber.
This raises an important question. What is management signaling to the market with this behavioral shift?
Right. Why now?
Immediately following that massive stock plunge in April, management executed $63.4 million in share buybacks. Going from 400 grand to over 63 million is an unprecedented acceleration in capital return.
But why would a notoriously conservative management team aggressively buy their own stock when we just proved it's historically expensive and offers no margin of safety?
You have to look at the mathematical mechanism of what a buyback actually accomplishes when a company's organic revenue growth stalls.
Okay, walk me through it.
When those turnkey AMI projects were delayed and Q2 revenue contracted by 7%, management realized they were powerless against the macroeconomic forces of municipal bond yields.
They can't control interest rates.
Exactly. But they do control their outstanding share count. By aggressively using their massive cash reserves to buy back and retire shares, they shrink the denominator in the earnings per share calculation.
Oh, I see. So even if the absolute total earnings of the company drop, the earnings per share number can stay flat or even grow simply because those earnings are being divided among fewer total shares.
Bingo. They are synthetically manufacturing EPS stability to appease Wall Street.
That is wild.
It is a highly institutionalized defense mechanism. They are using their pristine balance sheet to build an artificial floor under the stock price during a period of organic revenue stagnation.
Basically propping it up.
Yeah, it demonstrates an executive team that is acutely reactive to market pricing mechanics, and they are willing to aggressively protect that high multiple valuation.
However, the report highlights that they aren't merely playing financial engineering games to survive a bad quarter. They are actively deploying capital to buy their way into an entirely new frontier of the industry.
Right, they're looking ahead too.
They spent $185 million to acquire SmartCover in 2025, and they followed that up by acquiring UD Live in 2026.
This isn't just about water meters anymore.
This is the critical strategic pivot you have to monitor. Historically, Badger Meter was strictly in the business of measuring flow.
Right.
Their job was to tell a local utility exactly how many gallons of clean drinking water went into a specific house, so the city could send an accurate bill at the end of the month.
Simple enough.
But measuring clean water flow is slowly becoming a commoditized business. There's only so much technological innovation you can squeeze out of a billing meter.
So if the clean water billing side is commoditized, how do they justify the growth narrative? Like, where is the new frontier?
The frontier is the wastewater side of the grid. They are moving into predictive underground network diagnostics.
Predictive diagnostics. Yeah. The acquisitions of SmartCover and UD Live gave them highly advanced acoustic sensors. These aren't simple flow meters. These are sensors physically strapped to the underside of manhole covers.
Wait, really?
Yeah. They bounce sonar waves off the flowing raw sewage below to measure depth and flow anomalies in real time.
That is gross, but incredibly smart. So instead of just looking backward to generate a bill, the software can analyze the acoustic data and predict when a massive sewer main is going to back up and overflow into a city street before it actually happens.
Exactly the mechanism. By alerting a city to a blockage before the pipe bursts, BMI's software saves municipalities millions of dollars in EPA environmental fines and catastrophic cleanup costs.
The value proposition completely changes.
It does. They are transforming from a hardware company that facilitates billing into an indispensable predictive infrastructure diagnostics network.
That is a massive shift. So to summarize the journey we've taken you on today, Badger Meter is an incredibly well-run, debt-free, cash-generating machine that pulled off a brilliant digital transformation by attaching high-margin SaaS subscriptions to their hardware.
A brilliant move, honestly.
But they hit a cyclical wall in 2026. Municipal budgets tightened, inventory froze, and the market was brutally reminded that you cannot separate high-margin software from the physical friction of heavy infrastructure.
It's impossible to decouple them forever.
Right. It exposed the danger of applying Silicon Valley valuation multiples to a company that is still tethered to the reality of digging holes in the ground.
The ultimate lesson here is the vital importance of separating a phenomenal underlying business from a dangerous stock price. The operational mechanics of BMI are virtually flawless, but their current valuation demands absolute perfection in an inherently imperfect physical world.
Very well said.
And there is one final, almost chilling thread to pull on from this report regarding their future.
Oh, what's that?
As Badger Meter succeeds in its ultimate mission, as they transform thousands of disconnected, dumb municipal water pipes into a massive, interconnected, predictive SaaS network, they are effectively centralizing the critical operational data of our national infrastructure onto a single platform.
Oh, wow. I hadn't thought of that.
Yeah, their economic moat becomes incredibly deep, but the systemic risk profile changes entirely. As they house the real-time telemetry for thousands of North American water utilities on their Beacon platform, the primary threat shifts from supply chain bottlenecks to cybersecurity.
That makes total sense.
What happens when the next massive, state-sponsored cyber intrusion doesn't target a social media company or a bank, but targets the centralized software that controls the wastewater and drinking water analytics for entire regions of the country?
Wow.
The tractor didn't just get a GPS screen. The tractor is now connected to the national grid.
That is a terrifying operational reality to consider as they scale. Thank you for joining us on this deep dive. Keep questioning the numbers behind the narratives, look out for those valuation illusions, and we'll see you next time.